5 forms, sitting on a government website right now, completely free, and almost nobody born before 1965 has ever heard of a single one of them. That's not an accident. And by the end of this video, you're going to understand exactly why. This is the video where I walk you through the 5 IRS and Social Security forms most seniors in this country have never filed in their entire lives. Forms that could put real money back in your pocket before the June 30th window closes on you. I want to be blunt about something right out of the gate. This isn't a video for seniors who are struggling. It's not a video for wealthy retirees with complicated portfolios either. This is for every single person born before 1965. Whether your only income is a Social Security check or you're sitting on a paid-off house and a pension, there is money, real, legal, already. Yours money, trapped behind paperwork nobody bothered to explain to you. The IRS doesn't advertise savings. Your tax preparer doesn't get a bonus for telling you about a form you could file yourself in 20 minutes. So, before you do anything else today, hit subscribe and turn on notifications. Because I'm about to walk you through every one of these forms, one at a time, in plain English. Here's the part that should make you angry. And I don't say that lightly. The system you've been trusting your entire adult life, the system that takes money out of your check every single month, has almost no incentive to tell you when it's taking too much. Think about that for a second. Every dollar you don't claim doesn't vanish. It doesn't get burned in a fire somewhere in Washington. It sits in the system, working for the system. While you go without it, that's not a conspiracy theory. That's not some fringe claim I'm throwing out to get you fired up. That's just how a passive tax code behaves when the average person has never been taught to read it. It rewards the people who know to act, and it quietly, patiently takes from the people who don't. And I think most of you reading this were raised the same way I was. Taught that the IRS was not an agency you wanted to poke, not an agency you wanted to ask questions of. So you handed your paperwork to whoever charged you the least, signed where you were told, and hoped for the best. Hope is not a financial plan. Hope has never once put a dollar back in anyone's bank account. So today, we're replacing hope with information. Starting with the form that puts cash back in your monthly check faster than anything else on this list. Form W4P is, without exaggeration, the most ignored form in the entire IRS catalog, and it is the fastest acting one on this list. It's free, it's available directly at irs.gov, and its entire purpose is to control how much federal income tax gets pulled out of your pension, your annuity, or your IRA distributions every single month. Here's where the system quietly works against you. When most pension administrators and IRA custodians set up your withholding, they don't sit down and calculate your actual tax liability. They apply a default rate, a generic, one-size-fits-all number that assumes you have more taxable income than you actually do, especially once you factor in the extra standard deduction that kicks in at 65 and the additional senior deduction available in 2026. So what happens month after month? They take more than you owe, then in April, you get a refund, and you feel like you won something. Most people do. I need you to understand what that feeling is actually costing you, because that refund is not a gift. That was your money the entire year, sitting with the federal government, earning you exactly 0 interest while you waited for them to hand it back on their timeline instead of yours. Let's put a face on this. Take a retiree, we'll call him Harold, 66 years old, single, living in Georgia, pulling in a $38,000 annual pension. His pension administrator has him locked into a flat 10% withholding rate, which comes out to $3,800, pulled out of his pension every year. But once you actually run Harold's numbers, factoring in his age, 6.5 additional standard deduction, and the newer senior deduction available for 2026 filers, his real federal tax liability on that pension is closer to $1,400. That is a $2,400 gap. $2,400 a year that Harold has been loaning to the federal government, interest-free, without ever agreeing to it, without ever being told he had a choice, broken down monthly. That's $200 sitting at the IRS instead of sitting in Harold's checking account paying for groceries, gas, and prescriptions. Form W4P is how Harold fixes this. He pulls it from irs.gov, works through the withholding worksheet, and submits it to whoever administers his pension or IRA. And here's what makes this form different from almost everything else on this list. The correction isn't retroactive, it's immediate. His withholding adjusts starting the very next payment cycle. Not next year. Not after some review board looks at his file. The next check. I want you thinking about your own situation right now. Not hypothetically, not someday. Right now. Are you currently having federal tax withheld from a pension or an IRA distribution? Drop that answer in the comments, yes or no. because I'm building a follow-up breakdown specifically on how to calculate the correct withholding number for different retirement income situations, and your answers tell me exactly how many of you need it. This is not tax advice tailored to your specific return. Always run your numbers by a licensed CPA or enrolled agent before you submit anything. But the fact that this form exists, and that most seniors have never touched it, tells you everything about how quietly this system is designed to operate. Nobody calls you to explain it. Nobody flags it on your statement. You either learn about Form W-4P from a source like this, 1, or you keep loaning your own retirement money to the government for free, year after year, without ever knowing you had the power to stop it. That brings us to the second form. And this one hits every single person collecting Social Security, which is nearly every senior watching this. This is the form that decides whether your money gets held hostage for 12 months and handed back as a refund, or whether the correct amount lands in your account every single month like it should. Here's something that catches people completely off guard. Social Security payments arrive with 0 federal tax withheld by default, not 5%, not a small buffer. 0. For some of you, that's exactly right. If your combined income is low enough that none of your Social Security is taxable, you don't need withholding at all. But for millions of seniors, whose benefits are partially taxable, that 0 withholding default sets up a painful surprise every single April. They owe more than they expected, sometimes significantly more. And in some cases, they get hit with an underpayment penalty stacked on top of the bill, all because nobody ever told them Form W-4V existed. Form W-4V lets you choose your Social Security withholding rate directly. You're given 4 options: 7%, 10%, 12%, or 22%. And you pick the one that lines up with what you actually owe based on your real income picture. And I want you to hear both sides of this, because this cuts in 2 directions, and both of them are costing seniors real money. Some of you are underwithheld, walking straight into an April surprise you had no way to plan for, but plenty of you are the opposite, overwithheld, locked into a rate you set years ago when your income was higher, quietly overpaying every single month since, take a couple, we'll call them Dorothy and her husband, both 70, collecting a combined $34,000 a year in Social Security. Years ago, when their income picture looked different, her husband set their withholding at 22%. Today, with their current deductions and income level, their actual tax rate on that Social Security income is closer to 9%. That gap means they're overpaying by roughly $2,200 a year, more than $180 a month, that should be sitting in their checking account, covering groceries and prescriptions instead of sitting at the Treasury. Fixing this takes one form. You can submit a new W-4V directly online through your My Social Security account at ssa.gov. Mail it to your local Social Security office, or walk it in yourself once it's processed. You're withholding and just going forward from that point. And here's something I haven't told you yet that matters for where we're headed in this list. 2 of the 5 forms on this list were built specifically for seniors, 65 and older, not general taxpayers, not working adults filling out a standard return. Built for the exact demographic watching this video right now. We're about to hit the first of those 2, and it's a form millions of you are eligible for and have simply never used because nobody ever pointed you toward it. That third form is one the IRS built specifically with you in mind, and the fact that most seniors have never heard of it tells you something about how little effort goes into making sure this information reaches the people who need it. It's called Form 1040-SR, created deliberately for taxpayers 65 and older, and yet millions of seniors keep filing the standard 1040 every single year, completely unaware that a version built around their actual financial life has existed the entire time. Yes, the print is larger. That matters more than people give it credit for. But the real value isn't cosmetic. It's structural. The 1040-SR has a dedicated section built specifically for calculating the additional standard deduction available to seniors 65 and older. It lays out a cleaner, more direct path for reporting Social Security income and pension distributions, which happen to be the 2 most common income sources for people in your exact situation. And critically, it has built-in sections for the senior-specific deductions that plenty of preparers and software programs simply don't flag when they default you into the standard form. You can technically claim every deduction you're entitled to on the regular 1040. Nobody's saying otherwise. But the 1040-SR is built so the deductions and income categories that actually apply to your life sit right in front of you, instead of buried 3 schedules deep in worksheets a younger filer would never need to touch. So here's your action step. And I want you to actually do this before you sign anything this filing season. If you use a CPA or a paid preparer, ask them one direct question. Are you filing my return on Form 1040SR? If the answer is no, ask why not. If they can't give you a specific, clear reason for defaulting you to the standard form, instead, that's worth pushing on. If you file your own return through software, look for the senior return option before you submit. Most major platforms support it, though sometimes you have to confirm your age in the profile section before the software routes you correctly. This is educational information, not personalized tax advice. Always confirm your specific situation with a licensed CPA or enrolled agent, but the broader point stands on its own. A form exists that was designed around your life, and the system's default setting is to skip right past it, unless you ask. Now we get into the form that's quietly costing retirees with IRAs tens of thousands of dollars. Not because of anything illegal, not because of some loophole closing on them, but because nobody kept track of a single number they should have been tracking for years. So when you contribute to a traditional IRA, in most cases that contribution is tax deductible. You put the money in, it lowers your taxable income that year, and you pay tax on it later when you withdraw it. Straightforward. But some of you, particularly in years when your income sat above the deductibility limits, made what are called non-deductible IRA contributions. That means you put after-tax money into that account, money you had already paid income tax on once. And here's the trap. If nobody documents that after-tax amount, which is officially called your IRA basis, then when you start pulling distributions in retirement, the IRS has no record that any of it was already taxed. Every dollar coming out gets treated as if it were fully pre-tax, and they tax it again. You end up paying income tax twice on money that only should have been taxed once. First when you earned it, second when you withdrew it, and you may have absolutely no idea it's happening to you right now. Consider Robert, 68 years old, currently taking required minimum distributions. Over the course of his working years, he made $45,000 in non-deductible IRA contributions. Neither he nor the accountant handling his returns during those years consistently filed Form 8606 to document that basis. Now, because there's no documented basis on record with the IRS, his custodian reports his full distribution as taxable income. He's being taxed on $45,000. He already paid tax on once at a 22% federal rate, $9,900 in taxes he never should have owed. Gone for good, unless he or a current accountant goes back and fixes it. Form 8606 is how you document your IRA basis filed alongside your return for any year you make a non-deductible contribution. And here's what almost nobody knows. If you made non-deductible contributions in past years without ever filing this form, you can file amended returns to establish that basis retroactively, going back to the years those contributions were actually made. This form matters just as much if you've ever done or plan to do a backdoor Roth conversion. Without Form 8606 on file, the IRS has no record the original contribution was after tax. The conversion looks fully taxable on paper, and you pay tax twice on money that was already accounted for. If you've contributed to a traditional IRA at any point in your working life, and you're not 100% certain, every contribution was deductible, that's a conversation worth having with your CPA before June 30th, not after. Before I get to the most powerful form on this entire list, I need you to do something for me. If this video is opening your eyes to money you didn't know existed, hit that like button right now. Drop a comment telling me which of these 5 forms surprised you the most, and subscribe so you don't miss the follow-up breakdowns. I'm building on withholding calculations and IRA basis corrections. This channel exists to make sure information like this doesn't stay locked behind a $300 consultation fee, and I need your support to keep pushing it out to the people who actually need to see it. Now, the form almost nobody has heard of, and the one with the highest dollar impact on this entire list. To understand why it matters this much, you first need to understand something called IRMAA, the Income-Related Monthly Adjustment Amount. It's a Medicare surcharge tacked on top of your standard Part B premium that hits beneficiaries whose income crosses certain thresholds. Here's where I have to correct something. A lot of people online are getting wrong about 2026 numbers, because getting this precise actually matters when we're talking about your money. The standard Medicare Part B premium for 2026 is $202.90 per month, an increase from the 2025 premium. IRMAA surcharges begin at $109,000 in modified adjusted gross income for single filers and $218,000 for married couples filing jointly. Once you cross into surcharge territory, Total monthly Part B premiums for higher earners range anywhere from roughly $284 up towards $690, depending on which of the 5 income tiers you land in. And this is not a gradual slope. IRMA A operates as a cliff system, meaning exceeding an income threshold by even $1 triggers the full surcharge for the next tier, not a partial adjustment. That detail alone has blindsided more retirees than almost anything else in this entire system. Here is the trap that catches retirees specifically, and it is the part most people never figure out until somebody lays it out for them directly. Your 2026 Medicare premium is based on your income from 2024, Medicare's 2-year look-back rule. So if you retired partway through 2024, and your income that year was elevated because you worked the first several months, sold a business, took a large IRA distribution, or received a pension lump sum payout, Medicare is using that elevated 2024 number to set what you're paying in premiums right now. In 2026, even though your actual income dropped the moment you stopped working, you could be living entirely on Social Security and a modest pension today, a fraction of what you earned in 2024, and still be stuck paying a surcharge based on income you no longer have and are never going to have again. That's not fair. And to its credit, the Social Security Administration, which handles Medicare premium billing, built a direct correction mechanism into the system for exactly this situation. That correction is Form SSA 44. Form SSA 44 is a life-changing event appeal. It tells Social Security to base your premium on your current actual income instead of a 2-year-old number that no longer reflects your real financial life. Many advisors don't even file this appeal because they either don't realize it exists or assume it won't be approved, and the approval rate for legitimate life-changing events is actually high. There are 8 qualifying events that make you eligible to file this form: marriage, divorce or annulment, the death of a spouse, work stoppage, a reduction in work hours or income, the loss of income-producing property such as a rental you no longer own, the loss of pension income, or an employer settlement payment in a prior year that temporarily inflated your reported income. For most retirees watching this, the one that applies is simple work stoppage. Retirement. You stopped working, that alone qualifies you to file. Let me walk you through a real scenario that shows exactly what this correction is worth. Take a retired couple in Arizona, we'll call them Frank and Carol, both 67. Frank retired from his engineering career partway through 2024. Carol retired from her school district job a month later that same year, because they both worked several months into 2024 before stepping away. Their combined reported income that year was elevated enough to push both of them into IRMA A surcharge territory once Medicare applied its 2-year look-back for 2026. Based on the jump from no RMAA to the first tier, costing a couple roughly $2,297 per year, and the jump from Tier 1 to Tier 2, adding another $3,475, a couple, in Frank and Carol's position, pushed into the surcharge zone by a single elevated year they'll never see again, can be looking at several $1,000s in unnecessary annual premium costs. Both of them filed Form SSA 4, checking the work stoppage box, documenting their actual current retirement income. Social Security reviewed both appeals and reset their premiums back down to the standard rate, and because they filed early in the year, they recovered surcharges going back to January. That is thousands of dollars recovered from one free form, filed twice, taking maybe 20 minutes each. Form SSA 44 is available directly at ssa.gov. You can file it online through your My Social Security account, mail it to your local office, or walk it in yourself. And the correction, once approved, typically takes effect within 1 to 2 billing cycles. Now, let me give you the priority order for what to actually do with everything you just heard, because information without action changes nothing. Start with Form W4P. If you're receiving pension or IRA distributions and suspect you're overwithheld, download it from irs.gov, run the worksheet, and submit it to your administrator or custodian. Move to Form W4V if you're collecting Social Security and haven't checked your withholding rate in years. Verify it still matches your actual income. Ask your preparer directly about Form 1040SR if you're 65 or older and don't already. Know whether you're being filed on it. If you've ever made a non-deductible IRA contribution, get Form 8606 on record before June 30th, even retroactively if you have to. And if you retired anywhere in the last 2 years, and you're paying an IRMA-A surcharge that no longer reflects your real income, file Form SSA 44 immediately. It is the single highest dollar impact move on this entire list. Here's what I want you to sit with as you close this video out. None of these 5 forms are secret. None of them are loopholes. Every single one of them is sitting in plain sight on a government website, free, waiting for you to claim money that already belongs to you. The system isn't hiding this from you through some grand conspiracy. It's failing you through something far more common and far more American: negligence, indifference, and a complete lack of incentive for anyone in the chain to speak up on your behalf. Your CPA isn't paid extra to walk you through a free form. Your pension administrator isn't required to tell you your withholding is too high. Social Security isn't calling you to remind you that your premium is based on income you don't earn anymore. That responsibility falls on you, and now it falls on the people you know too. If someone in your life is 65 or older, a parent, a neighbor, a friend from church, send them this video today, because for some of them, this is worth thousands of dollars they didn't know they were owed. This information is educational only, not personalized tax or legal advice. So before you file anything, sit down with a licensed CPA or enrolled agent and walk through your specific numbers. But don't let that stop you from asking the questions. Subscribe to this channel, hit like if you made it this far, drop a comment telling me which form you're filing first, and follow me on Instagram for the daily breakdowns that don't make it into these full videos. Nobody else is going to hand you this information for free. I just did. What you do with it next is on you.